Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about SHOUGANG Resources Group Limited Annual Report. SHOUGANG Resources Group Limited is a diversified company that provides various businesses and services. The company's primary focus is on coking coal mining and production, with 3 major mines located in the Liaoning County of Shanxi Province. These mines cover an area of approximately 31.6 square kilometers and are primarily used to supply steel manufacturers. In addition to its core business of coking coal mining, SHOUGANG Resources Group Limited also engages in the sales of coking coal products. This suggests that the company has a strong distribution network and marketing capabilities to reach its target customers, which are mainly steel manufacturers. The company's operations are based in China, with its headquarters located in Hong Kong. With a history dating back to 1985, SHOUGANG Resources Group Limited has established itself as a significant player in the coking coal industry. Its name change in 2011 reflects its evolution and expansion into new areas of business. Overall, SHOUGANG Resources Group Limited's businesses and services can be summarized as follows: coking coal mining, production of coking coal products, sales of coking coal products to steel manufacturers. SHOUGANG Resources Group Limited market capitalization of 14 billion is significantly larger than the average industry peer of roughly 1 billion. This shows that SHOUGANG Resources Group Limited holds a significant advantage in their industry. SHOUGANG Resources Group Limited trades at a higher price-to-earnings ratio of 13 times and a higher price-to-book ratio of 0.87 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced, even though it is trading at a higher price to value than it appears. We will need to evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap. The balance sheet appears very conservative, with liabilities representing only 18% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The company have a dividend yield of 4.29%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be identified from the extracted summaries. On one hand, revenue growth was driven by several factors. The increase in raw coking coal production, volume from Xingwu coal mine, and the commencement of trading business of coal contributed to the growth. Additionally, effective cost control measures led to a decrease in materials consumption and labor costs. On the other hand, revenue decline was primarily due to various factors. A significant contributor was the decrease in sales of self-produced clean coking coal. The reduced demand from the steel industry, shift to electric arc furnace steel production, and changes in coal qualities also played a role. Furthermore, volatility in coal prices and a decrease in average realized selling prices of clean coking coal negatively impacted revenue. The loss of the largest customer, SHOUGANG Group Co. Limited, as a percentage of total revenue, was another significant factor contributing to the decline. Overall, these factors highlight the complexities involved in managing revenue growth or decline in the coal industry. The net income of the company experienced a significant decline, with a decrease of approximately 59% year-over-year. This drop was attributed to various factors, including a 30% year-wide decline in the average market price of medium-sulfur clean coking coal and changes in coal qualities that led to higher-priced low-sulfur clean coking coal ceasing production. The profit margins also underwent substantial changes. the gross profit margin decreased from 52% to 21%, while excluding the coal trading business, it dropped from 33% to 52%. Additionally, the adjusted gross profit margin declined from 52% to 33%. Furthermore, the EBITDA margin decreased from -46% to an unspecified value, indicating a decrease in profitability. The reasons behind these changes were multifaceted. The decline in market, deposit rates, and the decrease in gain on disposals of property, plant, and equipment also contributed to the decline in net income and profit margins. These factors collectively resulted in a significant reduction in the company's financial performance. The company's financial performance indicates a consistent trend of generating positive operating cash flow. According to the extracted summaries, the net cash inflow from operating activities has been steadily increasing over the years, with $110,900 in 2025 and $572 in 2024. Furthermore, the company generated a significant positive operating cash flow of approximately $917 million during the year under review. This suggests that the company is efficiently managing its operations to produce a substantial amount of cash, which can be utilized for various business purposes such as investments or debt repayment. The company's debt level has remained relatively stable over the past year, with no significant change between 2024 and 2025. However, there are some notable changes in interest expenses. Specifically, interest expense on lease liabilities increased by 8% from $746,000 to $886,000. Additionally, finance costs also saw an increase of $100,000, rising from $0.7 million to $0.9 million. These changes indicate a slight rise in the company's financial obligations, but overall debt levels remain stable. The economic landscape of the past year has been marked by varying degrees of success across different sectors. On a positive note, manufacturing and export demand have shown remarkable resilience, performing well throughout the period. This is a testament to the sector's ability to adapt and thrive in challenging times. On the other hand, the real estate sector has struggled, entering what appears to be a bottoming-out phase. Despite this, it remains to be seen whether this trend will continue or if there are signs of recovery on the horizon. The coal market has presented a mixed picture, with domestic supply initially high but returning to normal pace in the second half. Import-wise, the sector experienced a decline in 2025, only to rebound in the latter part of the year. Management is emphasizing a significant shift in the company's outlook and strategy. The primary focus is on becoming a safety-oriented and environmentally friendly enterprise, indicating a commitment to sustainability and social responsibility. In response to government policies and market trends, the steel industry will concentrate on quality improvement, efficiency optimization, and structural adjustment. This implies that the company is adapting to changing external factors while prioritizing its core operations. To achieve these goals, management has outlined several key initiatives. Firstly, the company will maintain stable production operations while prioritizing production safety and improving its safety management system. Secondly, it will advance the construction of intelligent mines at 3 mining operations, which suggests a focus on technological innovation and modernization. Lastly, the company will enhance its environmental, social, and governance (ESG) management system to support long-term, stable, and healthy development. This comprehensive approach underscores management's commitment to integrating sustainability into all aspects of the business. There is no notable activity in terms of acquisitions or divestitures. The company has not made any significant purchases or sales of assets, businesses, or subsidiaries that would be worth mentioning. This suggests a stable and consistent approach to business operations, with no major changes in the company's portfolio or structure. The company has a history of paying dividends to its shareholders. The most recent details provided show that in 2024, the company paid out a total of $512,539,839 in dividend payments. This includes both interim and final dividends for that year. Furthermore, the company has also proposed a final dividend for 2025, amounting to $305,464,000. It is worth noting that there is no information available on share buybacks by the company. The focus of the provided details is solely on the payment of dividends to shareholders. Concerns have been raised regarding the potential for inventory buildup and supply chain disruptions in a recent report. One key indicator of this issue is the significant increase in the cost of inventories sold. According to the data, the cost of inventories sold rose from $484,072 to $3,971,780. This substantial jump suggests that there may be an accumulation of inventory, which can lead to supply chain disruptions if not managed properly. The increased costs associated with inventory buildup can also have a ripple effect on the overall business operations and profitability. As such, it is essential for companies to closely monitor their inventory levels and implement strategies to mitigate potential risks. That concludes the financial summary for SHOUGANG Resources Group Limited. Feel free to comment below, and I will be happy to answer them when possible.